What's going on, guys? It is Dan Plata from Blue Skies Admin Services. We are cranking through another video here on our target budget spreadsheets. We are going to go through the assets and liabilities tab. So buckle up. It's going to be a lot of fun. Go check out all the other videos if you haven't seen them yet. There are videos specific to different industries. There's an intro video. There's videos for the sales and marketing tab, the payroll tab. This one's for assets and liabilities. And I will explain what I mean by that when we start looking at the sheet. So let's do it. Screen share coming at you. Here we go. So we are looking at the pressure washing budget. It doesn't matter that this is going to be pretty much the same for anybody out there. So I'm just using the pressure washing one because that's the first one I'm having go live here. But whether you're doing lawn care and landscaping and buying equipment or vehicles or window cleaning or janitorial, whatever you're doing, if you are buying vehicles and equipment and borrowing money in any form or fashion, this tab is going to be super important. Even if you don't use the sales and marketing and the payroll tabs, you still probably end up using this tab just to sort out different purchases you're going to make, things that are capitalized, meaning over $2,500, any loans you have on the books, and it really helps you manage your cash flows, not just your P&L, but like truly the cash coming and going from your business. So let me explain a little bit, nerding out on accounting here, what assets and liabilities. So assets are things that you own. Liabilities are things that you owe. So the difference between an asset versus an expense, like you go buy some equipment, if it's under $2,500, it just goes on the P&L as an expense. The profit and loss statement is a regular expense. If it's over $2,500, now it gets set aside as an asset on the balance sheet, which means it's something that you physically own and it's going to last longer than a year. And then your CPA depreciates it over time. So you get the tax benefit of the expense over time instead of immediately. Generally, it's best to expense things right now. You don't want to capitalize things. You want to expense them right now so you get the tax benefit right now instead of delaying it over time. But if it's over $2,500, you spread it over time. So anything that you plan on buying and or financing, it's helpful to use this sheet. You can see I've got a bunch of placeholders in here for multiple different assets, but let me kind of walk through the 1, 2, 3s here. So first, dollar threshold. If something is going to cost you over $2,500, you're going to want to plan on it on this sheet. It's not just going to be a regular expense on your P&L. So that's the threshold. When you do that, you're basically going to go into your QuickBooks and create that specific asset. I always recommend naming it with like any serial number, VIN number, the year of it, the make and the model, all the things that help you tell like specifically what that asset is. And then make sure your CPA knows about it, so they're the ones that can handle the expensing of that over time. And there's a specific tax form that does that. I won't get into the nuts and bolts of that. The other component that would hit the balance sheet is if you financed any of that equipment that you bought or that vehicle that you bought, that loan is going to hit your balance sheet as well. It's money that you owe. And when you pay that money back, typically part of that payment will be principal, which reduces the loan. Part of it will be interest, which actually is an expense on your P&L, reduces your taxable income. And so this sheet does that. It kind of feeds your cash flow statement and said, here's the principal you paid down, but it also feeds the P&L and says, here's your interest expense each month based on all these loans that you have. So just like the other tabs, there's a toggle here to say, yes, I want to use this, or no, I don't. And if you hit use, it's going to pull everything over into the budget versus actual tab from a interest expenses portion, from a depreciation expense portion, and from a cash flow portion. All that will feed into the budget versus actual tab. So for each asset, for each thing that you own and plan on buying, there's a spot to put the value of the asset. And I'd recommend, like I said, type the full name out of what it is, year, make, and model, all the things. Any down payment that you're making is super important to capture. That's going to be money that leaves your bank account, but it's not going to be an expense. Again, it's going to get capitalized as part of the asset. So you need to make a journal entry in your accounting system. If you don't know how to do that, just message me, because that's now we're talking about some real accounting. But you're always going to need to do some real accounting anytime you buy an asset like that and make a down payment. Whatever is not paid down, obviously, is money borrowed. And so this loan, you're definitely going to want to capture. Now, you will know in advance what those monthly payments are going to be and what the interest portion, what the principal portion of those would be. You should get an amortization schedule from whoever borrowed you the money that shows you throughout the duration of that loan, each payment, how much is going to be principal and pay down that loan, how much is going to be interest. You might not get a schedule like that if it's a variable rate loan and that interest rate changes month to month based on some factor that the bank deems. But at least you can kind of plan on a certain level maybe. So capturing the total amount of the payment, how much is principal, aka paying down the loan, and how much is interest. So you can see there's a placeholder in here for asset 1, asset 2, asset 3. The last line in here after interest is just annual depreciation for that asset. I just made up a number, but that you would want to get from your CPA. They're the depreciation gurus. They might choose to depreciate it a certain way based on the type of asset that it is or your current tax situation or some other CPA type of stuff. But that you're not going to spend a lot of time on. Just get it from your CPA, how much a certain asset is going to be depreciated in a certain year. So there's spots for 5 assets. You can always toggle and like shrink them if you don't want to see them all. Right now I just kind of have the whole thing fully expanded, if you will. So that's the asset section. Now the loan section would be from above. If you have those monthly payments, the loan section here would be any existing loan payments. So you might have loans on any of the assets you bought. It's totally fine to like have these be zero. They don't need to be anything. If you paid $40,000 down and borrowed zero, you obviously wouldn't have a payment there. That would be for a new purchase. For an existing loan, this would just help you kind of plan on the same thing and build it into your cash flows here. So if you had a monthly payment of $500 and 400 was principal, 100 interest, and so on, you could fill this out for each one. Again, get that depreciation for this for the coming year, whatever it is, from your CPA, so that you can build that out and plan on that for both for your tax purposes and for your cash flow purposes on these monthly payments. So we feed that down. So there's a whole section on existing loan payments. And again, keeping track of which asset that is. I even, for loans like that, I even will list who the financer is, because it's just so much easier if you're like, this loan is through Ally, and you know to go log into that bank account to get your principal versus interest split. Lastly, if you have a non-asset related loan, so just other loans, I've got a few placeholders for that. You might have got a PPP loan and you need to pay something back on that. You might have an SBA loan from something else. You might have a loan from your neighbor, Cindy. I don't know. Cindy's probably awesome. So any other loans that you have not tied to an asset, but that are going to have that payment with principal and interest every month, you can fill this out. And you might have just some existing other depreciation or amortization from previous assets that aren't listed on here, but you've bought in past years. Again, you can just get that number from your CPA. Hey, what's my depreciation going to look like for all of those assets that I had last year? How much am I going to have left to depreciate this year? And then you fill out the rest of this to add on anything else that's in existence, and you get your full-on depreciation number. So in this case, I'm saying here, I've got 10,000 of existing depreciation that I'm going to take this year, plus 50,000 from above on other assets and loans that I've got from this year, for whatever the case is. So I'm getting 60,000 of depreciation expense. And then it just totals up loan proceeds. Like if you borrow money, so here I've got a loan where I borrowed $20,000. That's cash flow coming in, right? I borrowed that money in. Cash outflows of when you're paying loans down. So there's $22,000 of cash outflows here, and it's all really tied. You can see there's a whole bunch of cells that are cash outflows, but it's all really tied to these down payments. Money going out the door. Again, it's money going out the door, but it's not going to hit your P&L. So it's a lot of times I hear people say like, it looks like my operating profit is great. It looks like I'm making money, but I have no money in my bank account. And it's usually for reasons like this. It's either distributions or balance sheet cash flows for making down payments or principal payments on loans. And then the last thing would be the total of all those interest expense lines from above. And that is going to feed right into your P&L. And that's going to be an interest expense. So these are like all totally made up numbers. But if I say let's use this baby. Boom. And we go to the budget versus actual. Here's where it's going to feed in. Under fixed expenses, interest is going to feed in from that tab. And you can see this is literally just pulling the data from the A&L tab. So if you're using that asset and liability tab to project your interest expenses, that's where that's going to go. The rest of those cash flows don't hit the P&L. So they won't be in anywhere in this budget. But if you scroll down past the, if you feel like diving in further, these two sections could be useful, here's where your depreciation and amortization starts to pull in. So if you didn't use that asset and liability tab, you just type your number in here. If you use that asset and liability tab, it's going to drop whatever you have way over here. We had 60,000, if you remember, of depreciation expenses. So that's what's pulling in there. Now that's budgeted. In actual, I just entered, we actually had 40,000 for whatever reason. Maybe we sold one of the things that we thought we were going to get depreciation on, so we didn't realize the full depreciation expense. I don't know, I'm just making something up. But in reality, we got 40, whatever. So this is going to be for your income for tax purposes, because that depreciation expense gets backed out of your income before you pay taxes. And then on the balance sheet, all those cash outflows, they get reflected in your bank account. Obviously, you got to pay down the loans. They don't hit your P&L. So we show them as budgeted balance sheet cash outflows. And this is, 20,000 of cash coming in, 22,000 of cash going out. The rest of the principal payments, you can see they actually keep jockeying up, because you, just like a mortgage, you pay a little more in principal every time as you pay down that balance. So that's it. That's the assets and liabilities tab. It's the things you own and the things you owe, and all the cash flows associated with them that generally we just totally overlook, totally forget about. But it has such a huge financial impact on what's going on in our bank account that we shouldn't do that. We should dial it in. So if you want to use that asset and liability tab, will be super helpful. Even if you're not using the sales and marketing tab, even if you're not using the payroll tab, I highly recommend using that asset and liability tab to hone in on all those cash outflows. It'll just give you so much more clarity on the difference between what your P&L says you're making and what your bank account looks like you're making. So that's it. Assets and liabilities, guys. Go get it. Again, if all this is hey, Dan, cool, I'm glad you know your stuff, but this is bookkeeping and accounting. It's super boring and I don't know what you're talking about. You can always hire us to do bookkeeping for you and keep track of this stuff, so you don't have to worry about it. You just have to know how you're doing. And if you have questions, find issues in my budget sheets, all that stuff, hit me up. Again, if you find an error, which I found one tonight while I was making these videos, so I just took an opportunity away from somebody. But if you find an error and I got to go back and make a change and resend out a sheet to people, whoever's the first person to find it gets a free 1-hour P&L review with me, a total strategy session, and we're going to dive into your P&L, usually a $200 thing, but it'll be free for helping me help everybody else. That's it. Good night. Well, it's nighttime here. It's 10:20. I better go to bed. All righty. Enjoy your target budget spreadsheet.